Public limited companies. Joint stock companies are also known as limited companies. A limited company sells shares to investors in order to raise money for the business. Shareholders are the owners of the business, but because in many cases there are so many of them, they will often appoint managers to run the business on their behalf. For example, Oak DIY wants to raise £10,000 for expansion by selling 1,000 shares at £10 each. The people who buy these shares are called shareholders. The more shares a person holds, the more of the company they will own, and the bigger will be their share of any profits. Suppose Oak DIY makes enough profit to pay £2 for every £10 share held. The profit paid out on each share is known as a dividend. A person who owns 10 shares will receive a total dividend of £20. While a person who owns 50 shares will receive a £100 dividend from profits. A public limited company must have a minimum of 2 shareholders. Shares are normally issued for sale to the general public on the stock market. The stock market is made up of all buyers and sellers of shares. Share prices and the quantity of the shares traded are determined by demand and supply, like in any other free market. The term going public is often used to describe a company that obtains a public listing to sell shares through a stock exchange. Stock exchanges are simply other business organizations, usually public limited companies themselves, that provide facilities for the issuing, buying, and selling of shares in public limited companies all over the world. Before a limited company can offer its shares for sale through a stock exchange, the governing body of the exchange will investigate the company to ensure that it is a trustworthy and well-run business and meets agreed standards of practice and size. The advantages of the public limited company is the same with the private limited company, but with addition features. Public limited companies can sell shares publicly, which means it can potentially raise huge amounts of money to finance its business operations than any other type of business organization. Public limited companies can publicly advertise their shares in newspapers and magazines, or even on television. This helps create interest in the sale and can attract many more investors. The public limited company shares the same disadvantages as the private limited company, but because of their size and the way they raise finance through sales of shares to the public, they can suffer additional problems. It can be expensive to form a public limited company. Many legal documents and checks are required before a firm can go public. Management diseconomies. There may be communication problems between different parts of business. Decision-making can be slow, and disagreements between managers and owners can occur. Shareholders own the company. Elected directors from voting control the company. Examples in Thailand: Loxley Public Company Limited, Thai Airways International Public Company Limited, Exchange of TMB Bank Public Company Limited.